In a previous lesson, the one where we talked about why people fail to reach financial freedom, we talked about the issue of procrastination. And the reason why this is a big deal is because if you procrastinate, you don't allow today's lesson's principle, which is time value of money, to work on your behalf, okay? So we mentioned in that lesson, and I recommend you watch it if you haven't, but the term compounding interest, okay? So then when we talk about time value of money, we need to understand what compounding interest is. And Albert Einstein said it, as you see on your slide there, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it, okay? So it's interesting because in our debt elimination video, we talked about, and I think we're gonna cover here also, how credit card companies, creditors understand this dynamic and put it to use against us typically, okay, against the consumer. So we'll touch upon that again, but we want to see how that can work in your favor. So Jason, walk us through, a little bit about what compounding interest really means, and then maybe give some examples.
Yeah, so exactly. So compound interest, just simply explained, is let's say you start with an initial deposit of money. Let's just say $1,000, okay? And a lot of times that's referred to as your principal.
Right.
Okay, and then the first year, let's say that $1,000 earns 10%. So the $1,000 goes up $100. Okay, so that the end of year one, it's $1,100.
Right.
Okay, and then on year two and going forward, you're getting same rate of return. Let's say 10%. But you're not only getting it on the principal, that initial $1,000,
right,
but you're also getting it on the interest that it earns.
Right.
And it just continues to build and build and build like that over time. So it becomes like an explosion of money over time.
Right.
And really grows, especially if you have a lot more time into it.
So again, $100 was the interest on year one, right? But year two, you get that $100. But then you also get 10% on the 100 you had gotten the year before, so that's another $10. So year two, it's 110.
Right.
Year three, then you add $11. So it starts increasing that, and that's what's called compounding, that increasing effect.
That's right, exactly.
So what does that do for investments?
Yeah, so take a look here at this chart. This assumes you start with $10,000 and it grows 10% annually. And you can see after 10 years, that $10,000 earns $25,000, or is up to $25,937.
The value.
The value is,
okay.
That's right. After 50 years, you get to $1.17 million only on $10,000.
Right.
Now, that's an example of compounding interest and the power of compounding interest. But a lot of times when people think about their investments and the growth of their investments, they're thinking in the form of what's called simple interest. In simple interest, the chart of a simple interest would be a linear, meaning a straight line chart. Versus, you can see how this one goes parabolic and it grows exponentially over time.
Right.
And so if you think about it, if you started with $10,000 and it grew 10% every year after 50 years, you would end up earning $50,000, okay, on top of that $10,000, so that's $60,000.
In the simple interest
example.
In
the simple interest example.
Right.
So compared to 1.1 million, in a compounding interest, when you're getting growth on that interest as well, and it's compounding over and over and over, and it's building upon itself.
Right. So this is also, and we're going to have a whole lesson on distribution, but if you have 10,000 and you earn 10%, and you took the 10% out, you still only have 10,000 for it to grow, right? So the next year you'd earn 10%. You take the 10,000.
Right.
So your only simple interest basically is the interest only applied to the principal.
That's right.
Okay. So and you see the big difference. In this case, 50 years is 60,000 versus 1.1 million dollars.
That's right. Now, as Paul mentioned before, and as Albert Einstein mentioned, those who understand compounding interest have it work for them.
Right.
Those who don't pay it.
Right.
So if you see on this chart right here, this is looking at the compounded growth of credit card debt. And so we're using a hypothetical example here where the average interest rate in America right now is 15% on credit cards. And so if you owed $10,000 and never made a payment to that, and I know that you'd have a lot of other issues, creditors calling you and all that,
right,
but just bear with me here. If you had $10,000 and you never made a payment on that, and you allowed that debt to grow at 15% per year, which is the average rate of interest for credit cards, then look what happens. In 50 years, it turns into $10.8 million. So you do not want compounding interest to work against you,
right?
Which is why we talk about very strongly in our foundation videos the importance of paying off that consumer debt first, so you don't have any monies working against you while you're trying to grow your money.
Right. I mean, the reality is this chart if you looked at it as far as how we feel, would be flipped, because you're getting deeper into the hole.
This is true.
Over time.
Yep.
So over time, oh my goodness, that interest seems unsurmountable.
Right.
Okay, so this is why you want to get rid of that bad money, anything working against you in your portfolio. If you haven't seen the debt elimination video, we encourage you to do so.
Yep.
So that's the power of compounding interest. But also, when we talk about time value of money, this is the first principle we need to know. But there's also, time is used in this other thing of, when should I invest? Is it a good time to invest? We're getting that question all the time. Is this a good time to invest? And that's refers to timing the market. Jason, talk to us about that.
Yeah, so timing the market instead of time in the market.
Right.
Timing the market is where you're trying to, the old adage of buying low and selling high.
Right.
And you're trying to do that. But very, very few people do that successfully over time. There's a very famous study that they do every year called the Dalbar study. And as you can see in this chart, and this looks at a 20-year period from 1999 to 2019, the S&P 500 had a return of 6.1%. Annually. Okay. The average investor had a return of 2.5%. Even bonds returned 5% over that time period. So the average investor, even if they invested in good funds, they would do it. They would get excited and they would buy when it was going up, but then they would get scared and sell when it was going down.
Right.
The exact opposite of the old adage, buy low and sell high.
Right.
They were buying high and selling low.
Right.
And that's the natural human tendency. We're kind of, our instinct is fight or flight. And when you get scared, typically you run when the market's down.
That's right.
And then that greed kicks in when you see the market going up. You want to be a part of that, and you get in after the market goes up.
That's right.
And so the average investor, and we've seen so many people do this unsuccessfully, is trying to time the tops and the bottoms of the market, and they're doing the exact opposite, and they end up with really poor performance.
And the interesting part is, when you're trying to judge, no one really knows what's the top and what's the bottom, right? I don't care. The best on Wall Street will eventually get it wrong, right? However, there's also a chart, and I encourage you to listen to one of Jason's economic market commentaries, okay, where we talk about and show how historically, what the market has done at different points, okay? Obviously, if you get in at the bottom, in the 1, 3, 5, 10 years, typically they're always up, okay? But it's interesting to see when you get in on what you think is a top, okay? Historically, for the most part, in the 3, 5, 7 year, it's always up, okay? And always up better than a savings account rate or things of that nature. So what's the alternative to not being in the market? Number one, and two, to trying to time it, which you're probably going to get it wrong anyway.
That's right.
All signs lead to, if you have the risk tolerance to be in the market, you probably should be. Does that make sense?
You should be, and you should leave it alone.
That's right.
And just allow it to do its thing. It's going to go up and down over time, and that's why it's important to have the right risk profile and take the risk that's appropriate for you, where you're not, where it's not a portfolio that's too volatile and it's going up and down too much. You're not comfortable with it. But if you can find the right mix of volatility, kind of up and down swings where you're comfortable with, then just let it do its thing. Because it's all about time in the market as opposed to timing the market, and just allowing those investments to grow for you over the long run, allowing that compound interest to work its magic over the long run. And that's the trick. Humans want to mess with things. People want to mess with things, so they think they can improve it. But in this circumstance, you just let it do its thing.
That's right.
And be willing to just kind of ignore when the market takes a big hit. And actually, the wise investors will a lot of times add to the markets when they're down.
That's right.
It's very difficult to do psychologically, but it ends up usually doing really well for you.
That's right. And understand, when you're talking about investing, the slide says it's long-term strategy. You don't save for the long term. You invest for the long term, and you don't invest for the short term. The opposite is true. So if I'm investing money, I shouldn't be thinking about, is this the right time? Because I'm thinking in terms of today, short term. And let's say this was the worst time, okay? And in a year your money went down. Well, let's add more money, because in a year hopefully it'll come up and recoup it, okay? So because you don't know if it's the best or worst, it's better to be in and stop trying to guess at something that no one can successfully guess over time.
That's right. Yep.
Does that make sense? So now it's interesting, because as we see the power of compounding, Jason, we want to show an actual example of this that could really be your case. So
that's right.
I know you have one of our calculators.
Yeah, absolutely. So as part part of AllGen Academy, we have helpful calculators that you have access to, and I'm going to show you one of those right now. This is what it looks like, but I'm going to actually flip over to it and give you an actual example. And so if we look here on our actual time value of money calculator, you can see here an example where, and this is how it works. So when you're using it, you can see how it works. All you're really filling out is these gray areas right here. So you can put your current age, and in this example, we put in a 30-year-old, and then the time frame that you want to be financially free, meaning some people would say retirement, but in how many years do you want to be financially free? And this person chose 30 years, so at age 60. They have a starting amount of money of $100,000, and they're going to put in $5,000 a year. Now, for this little sector right here, this cell says annual income growth rate. We have it at 0 right here, but what this is if you get, so typically over time, if someone wants to put, they're earning $50,000 and they want to put 10% of their salary away, right. That's $5,000. But most people over time get raises,
right?
So even if you just did like a cost of living of maybe 3% or inflation, where you get an inflation, a raise of 3% every year, then what happens is if you're contributing 10% to your investments, that's going to go up at 3% 10% per year.
Because a bigger number.
Yeah, that's right. So you can add that right here if you want. I didn't, and you got to be careful with it. You don't want to put it too high. You're not always going to get a huge raise every single year, and sometimes you may get a demotion and start at a lower amount. So to be safe, you can put 0, but if you want to put an actual annual income growth rate, you can apply 1 if you want. And then we have here the different risk profiles that you can choose. You can choose aggressive, moderately aggressive, balanced, conservative, and then there's even a tab for custom if you just want to put in your own percentage rate just to kind of see what it would do.
And that changes the interest rate?
It does. So you can see here aggressive is 8.5%, moderately aggressive is 7.5%, and it goes down from there. So in this example, like I said, you're 30 years old, starting off at $100,000, putting in $5,000 a year over the 30 years, growing at 8.5%. So at age 60, this person would have $1.829 million. So this is a calculator we give to you. It's a good thing to do. It can really open your eyes to the possibilities of compounding, and kind of, I think a lot of times it gives people inspiration to how they could grow their money over time, which sometimes is what they need to be able to really start and be disciplined at putting money in investing.
Yeah, and again, this chart, which we can change based on the input, you see how it does that curve, that parabolic effect. It starts kind of slow, but then over time, the whole saying of money making money, that it really starts kicking in over time. So in this case, they start with 100. For the next 30 years, they put in 5,000, which is another 150,000. So they put in 250, and they grew to 1.8, almost $2 million. Okay, that's real stuff. That's math. Right. So at the end of the day, what is the goal of understanding, the time value of money? It's to understand how powerful it is, how you want it to be working for you and against you versus against you, and once you do that, what the impact could be to create hope and the urgency to start doing something for your financial portfolio.
Apply it, right?
That's right, to apply it to your portfolio. So thank you for listening, and we hope to see you soon.